The Federal Reserve's policy meeting is underway. CBS News business analyst Jill Schlesinger is here. Jill, look into your crystal ball. What is the Fed expected to do?
I have my newly cleaned crystal ball, so I'm happy to tell you that I believe, and most economists think, that we're going to get a 1/4 percentage point interest rate cut. By the way, that would be the first cut since last December. I think it's likely to be the 1/4 percentage point because we know that although the labor market is weakening, we have seen consistent growth in the economy. And so I think if they were to do a 0.5%, there's a real fear that the Fed would fuel the economy too much. Just earlier this morning, we had a retail sales report that showed pretty robust spending by consumers. So I think the 1/4 point is what we get.
So you're thinking baby steps. What will this do for borrowers?
Hey, it's a little bit of a help. It's a step in the right direction. So I think we'll see interest rates come down on credit card balances and auto loans, though those levels still remain pretty high because of the last few years. And although the Federal Reserve does not control home loan rates, those have started to come down as well because people believe that all interest rates are heading lower. 30-year mortgage rates have slid to 6.35%, the lowest level of the year.
On the flip side, savers and retirement investors, is this good news or bad news for them?
Well, you know, savers are kind of bummed, but it's been a good run for 3 years. They'll see a little bit less interest on their savings and money market accounts and CDs. But if you look online, you can still find rates for those safer accounts of 3.5% to 4%. With investors, it's an interesting story because despite interest rates being high, investors have been enjoying new highs in stock market indexes. That's been driven by strong corporate earnings, particularly in the tech sector. Now, of course, I just have to remind you, before you get out the celebration and get real excited that your 401k went up to a certain level, know that at some point that party is going to end, at least temporarily. The key to being a sane long-term investor is to have a plan that incorporates both the good and the bad times.